Okay, well, good morning, ladies and gentlemen. I do admire your stamina in being up at this time on the last day. So the title of my talk, as you can see, is Gold Stocks, the Best Is Yet to Come. Some people might say the best, we haven't had anything yet. Well, let's not forget the gold stocks are actually up 40% in the last 12 months. I hear a lot of people complaining about the performance, but that's nothing to sneeze at, as we say. So let's start by looking at why the gold stocks have lagged over their traditional leverage, why that's happened, and then what's likely to happen to change that. So I'll run through the background quickly because I think we all know it. But the main reason that gold itself has gone up over the last 3 years is, of course, central bank buying. And you can see that very clearly on this, even though we've had a bit of a decline in the rate of growth in the last year, these are quarters, the buying is still significantly higher than it was pre-2022 and is likely to continue. And central banks, of course, are buying in order to diversify their assets in the face of dollar weaponization. That's unlikely to change with the new US administration, in my view, and that's as political as I get. The other major factor driving the price of gold has been Chinese buying, private Chinese buying, not official buying. And you can see here that in the last year, 10 months year, Chinese buying has shot up. That's Chinese people buying gold out of concern about a yuan devaluation and a decline in the economy, fragility of the banking system, not allowed to buy crypto, and so gold is the obvious place to buy. Now, there are some other buyers who are concerned about maybe the global fiscal situation and so on. But when you come to gold stocks, traditionally, North Americans have bought, and of course these buyers don't buy gold stocks. Sorry, that's an obvious statement, but I'll just say it. When you're the central bank of Uzbekistan and you want to you want to diversify your assets, you don't buy Newmont, let alone Ajax Exploration. You buy physical gold, and the same goes for the Chinese consumer. When we look at the North American who's potentially interested in gold stocks, or gold assets generally, what is it that attracts them to gold? What kind of economic environment? Well, I've already given a clue. It is the economic environment. And so if we look at where we have been in North America in the last few years, we've had a strong economy. I would argue with just how strong it's been, but certainly the narrative has been a strong economy, strong labor market. We've had high interest rates. We've had low inflation. We've had a strong dollar. Well, I ask you, does that sound like the sort of economic environment that really is conducive to gold buying? No, it's not. It's exactly the opposite. And then if you add on to that a rising S&P and TSX, if month after month after month, the mythical dentist in Oklahoma or wherever opens his brokerage statement and sees his account value go up, he doesn't really care whether NVIDIA is overvalued or Apple's cost of chips is going to go up or whatever. He just sees his value going up and is therefore less inclined or not inclined to look elsewhere to put his money. And so I think, although we ponder and we wonder why the gold stocks aren't any higher, it's not really completely illogical given the economic environment. I don't think it's illogical at all. And that's because gold itself has been driven by non-traditional factors. So let's look at what the interest is. This is the GLD. You all know that, the largest physical gold ETF. And you can see this year we've had a lot of buying as well as a lot of selling. I think it's fair to say that there's been some good buying, but hardly an overwhelming pouring of money into gold. But when we come to, and you can look at various surveys, there's Bank of America showing that 75% of financial advisors have less than 1% of exposure to gold assets. That includes physical and stocks. I would venture to bet that most of those people are at zero, not at 0.99%. But still, the vast majority have virtually no exposure. Or look at this one that came out 2 weeks ago from UBS, I think, but I can't read it from up here. And this is family offices. If you've got really good eyes and squint, you can see the gold allocation, which again is the same as for financial advisors, just under 1%. So there's certainly no particular interest in gold among investors of all types, family offices, retail, investment advisors, and so on. And this is reflected in the flows. If you look at the GDX, which is the largest gold mining ETF, you can see that up until the middle of May, there'd only been those tiny little, can you see them? Those tiny little green spots. These are daily net inflows, by the way, net inflows. We've had some inflows in the second half of May, but in the last week, they've turned to outflows again. For the year, it's a net, for the year to date, it's a net of $2.8 billion of net outflows. So again, hardly interest in gold or gold stocks. Now, if we look at the performance, gold versus the GDX, and the GDX tends to be the larger miners, larger and intermediate, you can see that the performance is essentially the same. And so when people say to me, oh, when are the gold stocks going to move? When are the gold stocks going to move? I always say, well, which gold stocks do you own? Because, you know, mine, Agnico and Franco and Wheaton, well, they haven't done too badly. I mean, 42% in 12 months is nothing to sneeze at. But nonetheless, we haven't seen the traditional leverage that we see from gold stocks at the beginning of a bull market. This chart here shows various times and various lengths. I just picked different lengths to show, to show that the leverage can be sustained. And we're calculating this from the bottom of the gold price, not the bottom of the gold stocks, but the bottom of the gold stocks. And you can see, I mean, look at 1986. Some of you won't remember that. Some of you weren't even born. But it was a pretty darn strong gold market, let me say, 1996, I'm sorry. And you can see that the gold stocks were up 82% compared with 6%. So in other words, the gold stocks did more than 10 times that of bullion. And again, you can see this for all of the different bull markets or short bull markets that I've mentioned. And we clearly have not seen that leverage this year. And this actually is the XAU, which is the senior stocks. When you come to the juniors, it's even worse. This is the S&P TSX Venture Metals and Mining Index. I think they should get a catchy name for that. I can suggest a few, but you can see that there's virtually no movement over 3 years in the juniors. We're seeing a bit of movement in the last 9 months, 6 months, but over 3 years, they're actually essentially flat. And where you do get performance, but the names of these stocks don't matter. I did them almost at random. But you see a few very strong outperformers among the juniors, and you actually see the majority have lost money. The majority of juniors as exploration companies have lost money. The thick line, by the way, is the GDX, just for comparison. So that sets the stage for sort of where we are. But the good news is that the environment is changing in a favorable manner. Canadian interest rates, you already know, have come down a lot. I thought I'd throw something in on Canada since I am here. But, you know, we've got a record gold price, and with that record gold price, we've got record and growing margins. You know, unlike 2004 to 2008, when the price of gold doubled, but the margins actually stayed the same, because the price of gold, the price of oil, the price of oil and the price of the commodity currencies moved up faster than the price of gold was rising. So you had a doubling of the gold price, but no increase in margin. Today we have quite the opposite. We've got the price of gold moving up dramatically, and the major cost inputs, even though everyone's complaining about inflation, the major cost inputs are staying the same or going down. So here's a graph that illustrates this, the gold-oil ratio, which has moved dramatically higher. I think that's 3 years, in the last 3 years. And when the ratio moves higher, of course, it means gold is moving faster than oil. Oil's the #1 cost input. If you look at the second largest cost input, which is your local costs, and so a proxy for local costs, not a proxy, but a reflection of local costs of a commodity, of the currencies in the countries in which you have mines, and we call those the commodity currencies, so Canadian dollar, Australian dollar, Brazilian real, South African rand, etc. All of those currencies, I don't need to tell you, have been weak. I know we've had a bit of strength in the Canadian dollar in the last few weeks, but they've been weak, and certainly much weaker than relative to gold. Gold has moved up a lot faster. I'll remind you, for those who weren't around last time, 2011, the last peak in the gold price, the oil price was $143 a barrel, that's US. Canadian dollar was trading at a meaningful premium to the US dollar. The Australian dollar was at a meaningful premium. The Brazilian real was one of the world's best performing currencies. And so last time you had quite the opposite, strong, high costs in the background of rising gold prices. But now we've got quite the opposite. And so this is, and this shows you the US dollar peaking. Okay, that's a positive for gold. It does, on the other hand, mean that other currencies are moving up, which we've just seen with the Canadian currency, but still lagging the gold price. And so what we see, this is reflected in margins. We see increasing margins, and these margins have been increasing for 10 years. You know, I wish every time I listen to a conference call for the last 2 years, the CEO spent half the time talking about how their costs are going up and what programs they have in place to control their costs. I don't know why anyone hasn't talked about how the price of gold is going up and the margins are going up. And so the margins now are projected to continue to go up. And so in this background of very high gold price, very strong margins, increasing margins, an improving macroeconomic environment as the US economy slows and we move, and the dollar has peaked and we move towards a phase of lower interest rates, the stocks are just still remarkably undervalued. And I'll just give a couple of examples, if I may. This is Barrick's price to book. Barrick's price to book is in its lowest decile in its 40-year history. Agnico Eagle, which of course is a great company with no particular hairs on it, is trading at close to its lowest decile of its price to cash flow, again, in its entire history. Now, this is perverse because normally multiples expand when the price of gold goes up. You can see that on this graph. In the previous peaks of the gold price, you saw higher multiples. Today, we're seeing these very, very low multiples. And so lastly, to conclude, this is the value of the S&P versus the XAU, the gold stocks. And you can see that the XAU is cheaper, sometimes by a lot, sometimes by a little, but the XAU is more undervalued than the S&P. which again is an extraordinarily rare occurrence. Those of you who've been in the markets, I don't actually see anyone, but I was going to say, those of you who've been in the markets for 50 years, ask your parents or grandparents, they will tell you that this is a very unusual circumstance. Gold stocks traditionally have traded at higher multiples than the S&P. And that's because we're all optimists, right? We wouldn't be in this business if we weren't an optimist. So the conclusion I'm giving you is that this is an incredibly good time to be buying the gold stocks, notwithstanding the fact that we've seen this 40% increase in the last 12 months. They remain extremely undervalued in the context of a very favorable macro environment. Thank you very much.